What is the best loan program that you should be considering when you're looking at purchasing a home, particularly your first home? That is what we're going to be talking about in this episode of the Greatest Asset Community Podcast. So a lot of people just dive headfirst into getting an FHA loan, and that might not necessarily be a bad option. However, there could be better options out there for you, and that's what I want to discuss here so that you can know how to best position yourself to save money in the long run in that loan that you're looking to get to purchase that first home as well. So starting off with the first thing, your credit score. If your credit score is below a 700, you're going to want to lean towards that FHA loan. And the reason is because of mortgage insurance. Mortgage insurance, if you have less than a 20% down payment, is something that's required on financing for a home or on home loans. So if you're not putting at least a 20% down for a down payment, which most people aren't putting 20% down because that's a lot of money to put down for a home, then you're going to have mortgage insurance on that home. With an FHA loan, mortgage insurance is not based on your credit score. Mortgage insurance is a set percentage for just about all FHA loans. However, when it comes to a conventional loan, mortgage insurance is heavily based on your credit score. So let's say if you're going a conventional route and you have that 620 or that 650 credit score, you could qualify for a conventional loan, but your monthly payment might be hundreds of dollars more per month because your credit score is not well above 700. So that's the first thing that you want to look at is your credit score. If you got a credit score that's above 700, now you still want to look at, would it be better for you to go conventional or would it be better for you to go FHA? Because in some instances, especially considering how high your credit score might be, it might be more advantageous for you to go the conventional route because you might actually have cheaper mortgage insurance if you've got a really high credit score. So that's something you want to pay attention to first and foremost. Let's get on to the second thing. Down payment assistance. We know that the cost of homes are expensive these days. And so a lot of people need down payment assistance to help cover those upfront costs for the down payment as well as the closing cost as well. So if you are in need of down payment assistance, understand that the majority of down payment assistance programs fall under an FHA loan. And so if you're needing down payment assistance, that's going to just about default you to having to take the FHA route. Now, there are some grant programs out there, some down payment assistance money that you can get that will allow you to go conventional or stay conventional if that's what you really want. I'm just letting you know that your options are going to be limited in terms of what you have available to you if you do want to stay conventional and use down payment assistance, because most of those down payment assistance programs fall under FHA loans. So credit score is the first thing. If you got below a 700, let's lean towards that FHA route. And I also didn't mention there are a couple other options that you have in addition to just FHA and conventional. If you're a veteran, you should 100% be looking at going VA. VA is a loan that you can use over and over and over again. There's no limit to how many times you can use it. There's no down payment required, no mortgage insurance required, no minimum credit scores. There's no purchase price limit if you've got full eligibility and you haven't used any of that eligibility up yet. So you've got so many options with the VA. If you're a veteran, that should be your number one option. And USDA is another option out there. I'm going to address that a little bit towards the end of this broadcast because USDA has some unique things in there. So I'm going to put that one separate, but just wanted to put those two out there as well. Those are other options that you do have. If you're a veteran, look at VA, period. And if VA is not working for you, then look at something else, but look at VA. That's going to be your best option. That's, in my opinion, the best loan program out there, period, is the VA loan. But getting back into where we were at. So the first thing is your credit. If you're below a 700, you should be leaning towards that FHA route. If you're above a 700, especially well above a 700, then you should be considering possibly going that conventional route as well, because there are going to be some positives in that conventional as well. But then the next thing we talked about was down payment assistance. So that was the second thing, is if you are looking at needing down payment assistance to purchase a home, that's going to limit the options you have if you want to stay conventional, because most down payment assistance programs fall under FHA guidelines. It's for FHA loans. And so that's another thing you're going to want to consider is, do you really want to, have the down payment assistance and have to go FHA? And there's nothing wrong with going FHA, but this brings me to the third thing that I want to speak about. And that is, what are your plans in terms of the interest rates you have now and refinancing that into the future. Now, this is where I'm gonna put a pin in and talk a little bit more in depth on, because there are some things that you're going to want to consider scenario wise. So let's say, for example, that you are purchasing a home and you have the option to go FHA and conventional. And let's say that you don't need down payment assistance, or you found a down payment assistance program that will work with both FHA or conventional loan. Now you're in a position to where you have to decide which one you want to go with. Which one is going to give you the better interest rate? Now, I'm going to tell you that in general, you will find better interest rates for an FHA loan. FHA is a government-backed loan. Conventional is a private loan. So in general, you're going to find better interest rates for an FHA loan than what you'll find for a conventional loan. So that's one thing you're going to want to consider there. It's possible for you to get the same interest rate on a conventional loan as what you can get on an FHA, but it might cost you a little bit more money up front. You might end up having to pay some discount points up front in order to buy that conventional rate down to where you could get it under an FHA loan without having to pay those additional things. But one thing you also want to consider with a conventional loan, there is no upfront mortgage insurance. So with an FHA loan, all FHA loans, they require an upfront mortgage insurance premium, 1.75% of the loan amount. So let's say that if you were buying a $100,000 home, 1.75% of $100,000 is $1,750. And that's what you have to pay. But if you're buying a $400,000 home or $500,000 home, times that by, or you're getting a $500,000 loan rather, times that by 1.75%, and you'll see how much you're actually going to have to pay an upfront mortgage insurance premium. Now, you can finance that into the loan amount. So it's not that you have to come out of pocket with that money. And again, we're talking about for FHA loans, that upfront mortgage insurance premium. You can finance that into the purchase price of the home. So you don't have to come out of pocket with like $5,000 or whatever it would be for your upfront mortgage insurance. However, if you finance that into the loan, now you're paying that plus interest. So that's something that you want to consider when you have that. So you don't have that with, and that's going to up your monthly payment just a little bit more when you're going FHA as well because of that upfront mortgage insurance premium. With conventional loans, you don't have that upfront mortgage insurance premium, but you are going to have that monthly mortgage insurance. So that's something you want to be aware of. But a third thing that I do want to mention when it comes to FHA and conventional, and particularly like when I started this, I talked about, your plans with refinancing and everything, is what the interest rate is that you're getting, and are you going to be refinancing this thing or planning on refinancing these things? For example, a lot of people who purchased homes during the pandemic, 2020, 2021, they got really great interest rates that they're probably not going to be refinancing out of those interest rates. That's how low they are. And so with that, it would have been advantageous for everyone who purchased during that time to jump into a loan program that would have had the mortgage insurance coming off. So what I mean is that, like I stated earlier, if you purchase a home and you have less than a 20% down payment, which is just about the overwhelming majority of everyone who purchased homes has less than 20% that they put on a down payment. Most people are only putting 3% or 3.5% down for their down payment. So when you do that, you have to have mortgage insurance. But with an FHA loan, when you're only putting 3.5% down, that mortgage insurance stays on the loan for as long as you have that loan. So if you keep that loan for 10, 20, 30 years, you're going to always be paying that mortgage insurance. But for a conventional loan, that mortgage insurance will fall off once what you owe on the home becomes 80% or less than the value of the home. Once it's at 78% or less than the value of the home, it automatically falls off. But once you hit 80% of the value of the home, you can actually request to have that mortgage insurance come off of that loan as well. And that will help reduce your monthly mortgage payment. Because let's say, for example, if you're paying $100 a month in mortgage insurance and you have an FHA loan, you will forever be paying mortgage insurance based on the loan, the principal amount of the loan balance that you still owe. However, if you have a conventional loan, as you're paying down that principal balance, once you get to where you owe 80% or less than the value of the home, then you can request to have that mortgage insurance come off. And now you're saving that $100 a month as well. So how quickly can it come off? It depends. If the home prices appreciate quickly, then let's say over the next 2 years, 3 years, maybe the home prices appreciate quickly and you request to have it come off, because now that home that you purchased for $300,000 is now worth $400,000 or $450,000 or whatever, because over the last 3 years or 4 years, homes just went straight up like we saw in the pandemic. People could request to have that mortgage insurance come off, and now they're saving even more money on that monthly mortgage payment. So that's one thing that you can do to reduce that, but you only have that option if you go conventional. You don't have that option if you go FHA. So that's another thing that you want to consider. So again, that third one, a little bit more in depth, but let's rehash these three again. So first thing, you want to check your credit. If your credit score is below a 700, lean towards the FHA. If you're above 700, let's start looking at both options, and you can have your mortgage lender run both options for you so that you can see which one's going to be more advantageous. But they also may just be able to guide you, because a great mortgage lender who's been doing it for a while, run a lot of files, they'll just be able to let you know, hey, this is how much you're going to be looking at for an interest rate if you go conventional. This is how much you're going to be looking at for an interest rate if you go FHA. This is how much you're going to be looking at for mortgage insurance. This is what your monthly payment's going to be. And they can run all those numbers for you to give you an idea. But credit score, that should be your first stop, is do I have above a 700? If no, let's look at FHA. If yes, let's consider both options and see which one pans out better. Second thing, am I looking for down payment assistance? Because if I need down payment assistance, you're probably going to end up with an FHA loan. Just saying how it is, the overwhelming majority of down payment assistance programs require FHA loans, not conventional loans. So that's the second thing. The third thing, again, got a little bit more in depth, is what are you looking at when it comes to the refinance later on down the line? And what is it that you're going to be needing monthly payment wise as well? Because again, interest rates are going to be higher when you go with that conventional loan. More often than not, they're going to be higher with that conventional loan than what they will be with that FHA loan. So you want to look at how much are you going to have to pay for an interest rate on a conventional side versus going FHA. But you're also going to want to look at how much is the mortgage insurance difference going to be, because your mortgage insurance, depending upon what your credit score is, may be higher for a conventional loan. But if you have a high enough credit score, it might actually be lower for a conventional loan. All depends on what your credit is. And remember, that last thing I spoke about is your ability to refinance. Now, if you're getting a higher interest rate, I'll mention this one thing really quickly as well. If we're in an interest rate market environment where, let's say, interest rates are at 8%, and you're getting a higher interest rate, rather, that you're like, okay, I know I'm not going to want to keep this 7% interest rate or 8% interest rate for a long period of time. So you're going to hopefully be refinancing out of that loan in the next year or two, then go with the cheaper route. And if the cheaper route is FHA, go with FHA, because you're going to be refinancing this thing. You can always refinance into a conventional loan later when interest rates drop. But if you are in a situation where you are going to be getting a great interest rate, let's say you're going to be hopping in this thing at a 5% interest rate, a 4% interest rate, then you might want to consider a loan program that's not going to have a refinance that you're going to want to do later on, and will allow you to still reduce that monthly payment, i.e. think about going conventional. If you can get that 5% or that 4% interest rate going into a conventional loan, you could keep that interest rate for the life of your loan and not even have to worry about refinancing it. Don't think about 2 and 3% interest rates. We may never see that again. The pandemic was a one-off, and you may live the rest of your life and never see that again. So if you're able to get into a 5% interest rate or even a 4% interest rate, you could keep that interest rate for the life of the loan. And in that instance, you really do want to consider possibly going conventional rather than FHA. And the reason is because with that conventional loan, your mortgage insurance will eventually come off automatically once you owe 78% or less than the value of the home. But once you owe 80% or less than the value of the home, you can request to have that mortgage insurance come off as well. So you reach out to your mortgage company and say, hey, I want to request to have my mortgage insurance come off of the home once you know the value of that home is, or once what you owe on the home is 80% or less than what that home is actually worth. You can request to have that come off, and that could save you, you know, $80, $100, $150, 180, 200 bucks, however much you're paying for mortgage insurance, it could save you that much every single month on your monthly mortgage payment. And since you're in a loan where you have a lower interest rate, i.e. you're not needing to refinance this thing, you don't want to have to be stuck in an FHA loan where now you're going to have to pay that mortgage insurance for the life of the loan or refinance. Because if you go the FHA route, but then you want to refinance to get the mortgage insurance off, refinancing is going to come at a cost. A lot of times there's upfront cost. It may cost you a few thousand dollars that they're going to add to the principal balance of the loan, but also it's going to cost you on your amortization schedule. And what I mean by that is, I'm throwing a lot at you right now, but this is really good stuff. Trust me, you want to pay attention to this. When you get a loan, at the beginning of that loan, particularly within that first like 5-10 years, you're paying heavily, mostly interest on that loan. So if you are 3, 4, 5 years into a loan, and now you're at a point to where you have enough equity in that home to where you can refinance and have the mortgage insurance come off, once you refinance, it resets that amortization schedule, which means that you can refinance into a conventional. It's going to cost you a few thousand dollars, but you could refinance into that conventional. Maybe you find a way to refinance where it doesn't cost you anything. But in either case, once you refinance, it's going to reset that amortization schedule, which means that now you're in a new 30-year loan. And even though you have a lower payment, most of that payment is now going toward principal. Or now towards interest rather, excuse me. Most of that payment is going toward interest. So whereas you had an FHA loan where, you know, you were 5 years, 6 years, 8 years into this thing, and you were paying a little bit more in principal, a little bit more in principal. And every month you pay a little bit more principal and a little less interest. Now, when you refinance, it resets it all over again. And the overwhelming majority of your payment is all interest that's just going to your lender, and it's not as much principal that's actually helping to put equity back into your pocket. So being able to avoid that refinance can also help you more quickly get that loan paid down and more quickly put equity in your pocket as well. So those are some of the things that you want to keep in mind, making sure that 1, credit score below a 700 or above a 700, below FHA, above, consider both FHA and conventional, and 2, down payment assistance. Your options are going to be mostly toward the FHA route there. And then 3, look at, you know, how much the interest rate costs are going to be with FHA and conventional, as well as refinancing this thing as well. Because if you have a low credit score, you don't want to have, or not credit score rather, but if you are getting a low interest rate, then you don't want to have to refinance that thing just to drop the mortgage insurance. So go ahead, look at getting that conventional loan since you're getting a great interest rate, and that way you don't have to refinance later, and that mortgage insurance will fall off hopefully within a few years. And so that's what I have for you. I did tell you that I was going to mention USDA loans really quickly at the end. So this is what I'm going to say about USDA. If you are purchasing in an area that qualifies for a USDA home, and we're talking an area that's in a rural or suburban area, you have to pull up the USDA eligibility map, which you can find for free. If you Google USDA eligibility map, you type in the address of whatever property you're looking for, and it will tell you if that address qualifies for a USDA loan. If your home that you're looking for qualifies for a USDA loan, there are some perks with USDA loans because there's no down payment. There is mortgage insurance, but the mortgage insurance is less than what you would pay for an FHA loan. So, you know, very competitive mortgage insurance prices. But one thing you need to be wary of is that with USDA loans, they can be harder to qualify. For one, they are geared for low to middle income borrowers, and they look at the income of everyone that's in the house. So if you've got 2 adults or 3 adults that are living in the household, even though only one might be on the loan, they're going to look at the income of every adult that's living in that home to determine whether or not you are below that minimum income requirement threshold. And so if you by yourself may be under it, but once we add you and your spouse or you and another adult, or even an adult child that might be living in the house, now that might push you up over that threshold and you no longer qualify for that USDA loan. Also, the credit score requirements for USDA, there aren't any stated minimum credit score requirements for a USDA loan. However, it is increasingly harder to get qualified for a USDA loan if your credit score is below a 640. So you want to have a credit score that is ideally above a 640 for you to be qualified for that USDA loan. So if you fall into those categories with those two things, credit score that's above a 640, ideally above a 700, but credit score above a 640, and you are below the minimum income requirements, then you are in a situation to where, you know what, consider that USDA loan if you find a home that is in a USDA eligible area. So that's what I have for you. Thank you for taking the time to tune in. As always, make sure you're watching us on Tuesdays live, 7 p.m. Eastern, Home Finance Hacks. I'm putting out all of the tips, the tactics, the tools that are going to help you save hundreds of dollars on your monthly mortgage payment, thousands of dollars even over the course of a year, or tens of thousands of dollars over a year or more. So you're going to want to make sure you tune in 7 p.m. Eastern live on right here on YouTube. We go live for Home Finance Hacks. So make sure you tune in. And as always, we'll see you in the next episode. So take care, be blessed, and we'll see you in the next episode.